Welcome to Thoughts on the Market. I'm Michael Zezas, Morgan Stanley's Global Head of Fixed Income and Public Policy Research.
And I'm Matthew Hornbach, Global Head of Macro Strategy.
Today, we'll talk about U.S. fiscal policy expectations under the new Trump administration and the path for U.S. Treasury yields. It's Thursday, January 30th at 10 a.m. in New York. Fiscal policy is one of the four key channels that have a major impact on markets. And I want to get into the outlook for the broader path for fiscal policy under the new administration. But Matt, let's start with your initial take on this week's FOMC meeting.
So investors came into the FOMC meeting this week with the view that they were going to hear a message from Chair Powell that sounded very similar to the message they heard from him in December. And I think that was largely the outcome. In other words, investors got what they expected out of this FOMC meeting. What did it say about the chance the Fed would lower interest rates again as soon as the March FOMC meeting? I think in that respect, investors walked away with the message that the Fed's baseline view for the path of monetary policy probably did not include a reduction of the policy rate at the March FOMC meeting, but that there was a lot of data to take on board between now and that meeting. And of course, the Fed, as ever, remains data dependent. All of that said, the year ahead for markets will rely on more than just Fed policy. Fiscal policy may feature just as prominently. But during the first week of Trump's presidency, we didn't get much signaling around the president's fiscal policy intentions. There are plenty of key issues to discuss as we anticipate more details from the new administration. So, Mike, to set the scene here, what is the government's budget baseline at the start of Trump's second term, and what are the president's priorities in terms of fiscal policies?
I think the real big variable here is the set of tax cuts that expire at the end of 2025. These were tax cuts originally passed in President Trump's first term. And if they're allowed to expire, then the budget baseline would show that the deficit would be about $100 billion smaller next year. If instead the tax cuts are extended and the President Trump were able to get a couple more items on top of that, say, for example, lifting the cap on state and local tax deduction and creating a domestic manufacturing tax credit, two things that we think are well within the consensus of Republicans, even with their slim majorities, then the deficit impact swings from a contraction to something like a couple $100 billion of deficit expansion next year. So there's meaningful variance there. And Matt, we've got 10-year Treasury yields hovering near highs that we haven't seen since before the global financial crisis around 10 years ago. And yields are up around a full percentage point since September. So what's going on here, and to what extent is the debate on the deficit influential?
Well, I think we have to consider a couple of factors, the deficit certainly being one of them, but people have been discussing deficits for a long time now. It's certainly news to no one that the deficit has grown quite substantially over the past several years, and most investors expect that the deficit will continue to grow. So concerns around the deficit are definitely a factor, and in particular, how those deficits create more government bond supply. The U.S. Treasury, of course, is in charge of determining exactly how much government bond supply ends up hitting the marketplace. But it's important to note that the incoming U.S. Treasury Secretary has been on the record as suggesting that lower deficits relative to the size of the economy are desired. Taking the deficit to GDP ratio from its current 7% to 3% over the next 4 years is desirable, according to the incoming Treasury Secretary. So I think it is far from conclusive that deficits are only heading in one direction. They may very well stabilize, and investors will eventually need to come to terms with that possibility. The other factor I think that's going on in the Treasury market today relates to the calendar. Effectively, we have just gone through the end of the year. It's typically a time when investors pull back from active investment, but not every investor pulls back from actively investing in the market. And in particular, there is a consortium of investors that trade with more of a momentum bias that saw yields moving higher and invested in that direction. That, of course, exacerbated the move. And of course, this was all occurring ahead of a very important event, which was the inauguration of President Trump. There was a lot of concern amongst investors about exactly what the executive orders would entail for key issues like trade policy. And so there was, I think, a buyer's strike in the government bond market really until we got past the inauguration. So, Mike, with that background, can you help investors understand the process by which legislation and its deficit impact will be decided? Are there signposts to pay attention to, perhaps people and processes to watch?
Yeah, so the starting point here is Republicans have very slim majorities in the House of Representatives and the Senate. And extending these tax cuts in the way Republicans want to do it probably means they won't get enough Democratic votes to cross the aisle in the Senate to avoid a filibuster. So you have to use this process called budget reconciliation to pass things with a simple majority. That's important because the first step here is determining how much of an expected deficit expansion that Republicans are willing to accept. So procedurally then, what you can expect from here is the House of Representatives take the first step probably by the end of May, and then the Senate will decide what level of deficit expansion they're comfortable with, which then means really in the fall we'll find out what tax provisions are in, which ones are out, and then ultimately what the budget impact would be in 2026. But because of that, it means that between here and the fall, many different fiscal outcomes will seem very likely, even if ultimately our base case, which is an extension of the TCJA with a couple of extra provisions, is what actually comes true. And given that, Matt, would you say that this type of confusion in the near term might also translate into some variance in Treasury yields along the way to ultimately what you think the endpoint for the year is, which is lower yields from here?
Absolutely. There's such a focus amongst investors on the fiscal policy outlook that any volatility in the negotiation process will almost certainly show up in Treasury yields over time.
Got it.
On that note, Mike, one more question. Could you walk me through the important upcoming dates for Congress that could shed light on the willingness or ability to expand the deficit further?
Yeah, so I'd pay attention to this March 14th deadline for extending stopgap appropriations because there will likely be a lot of chatter amongst congressional Republicans about fiscal expectations. And it's the type of thing that could feed into some of the volatility and perception that you talked about, which might move markets in the meantime. I still think most of the signal we have to wait for here is around the reconciliation process, around what the Senate might say over the summer, and then probably most importantly, the negotiation in the fall about ultimately what taxes will be passed, what that deficit impact will be. And then there's this other variable around tariffs, which can also create an offsetting impact on any deficit expansion. So still a lot to play for despite that near-term deadline, which might give us a little bit of information and might influence markets on a near-term basis.
Great. Well, Mike, thanks for taking the time to talk.
Matt, great speaking with you. And as a reminder, if you enjoy Thoughts on the Market, please take a moment to rate and review us wherever you listen and share Thoughts on the Market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.